Most 401k participants know, at some level, that mutual funds charge a fee called an expense ratio. It is disclosed somewhere in the fund's paperwork. It is a small decimal number, 0.75%, 1.1%, and because it looks small in isolation, most people dismiss it and move on. That is the first layer, and it is not the only one. Layer 1, the expense ratio. This is the annual fee charged by the mutual fund to manage your money. For actively managed funds, the kind that employ a team of analysts to select stocks, this typically runs between 0.5 and 1.5% per year. For passive index funds, it runs between 0.03 and 0.2%. That gap, which looks like a rounding error in any single year, becomes the $250,000 difference we just calculated over 30 years. Layer 2, the 12B1 fee. In 1980, the SEC passed a rule called Rule 12B1. It authorized mutual funds to charge investors an additional annual fee, on top of the expense ratio, ostensibly to cover the fund's marketing and distribution costs. In plain language, the fund charges you an ongoing fee to advertise itself to other investors. This fee can reach 1% per year. It is embedded inside the expense ratio number that investors see. It does not appear as a separate line item. Most participants have no idea it exists, which is, of course, the point. Layer 3, the plan administration fee. Your 401k requires administration, record keeping, compliance work, the website where you check your balance. That administration costs money, and that cost is typically passed to plan participants as either a flat annual fee, a percentage of assets, or both. These fees typically run between 0.25 and 1% of plan assets per year. They are disclosed in documents called Form 5500 filings and fee disclosure statements that are technically available to every participant and practically read by almost none of them. Layer 4, revenue sharing. This is the layer that most closely mirrors every other corporate corruption story you already know. Here is the mechanism. Your employer selects a 401k plan provider, a record-keeping company, to administer the plan. That provider also builds the fund menu from which employees choose their investments. In theory, those funds are chosen in your best interest. In practice, many of them are on the menu because the fund companies pay the record keeper to be included. These payments are called revenue sharing arrangements. A fund company pays the plan administrator a percentage of the assets that participants hold in their funds. The administrator is therefore financially incentivized to include higher-cost funds that generate more revenue sharing, not the lower-cost alternatives that would leave more money in your account. The expensive funds are on your menu because they paid to be there. The cheap ones that would serve you better may not appear at all. This practice is legal. It is disclosed in documents constructed to be unreadable. And the Department of Labor has estimated it costs American retirement savers approximately $17 billion per year. That is not a metaphor. That is a transfer from millions of retirement accounts to the financial services industry every year, in the background, while you are focused on your actual job. If you enrolled in your 401k and, confronted with a menu of 15 funds whose names were functionally meaningless to you, selected the Target Date 2050 fund and moved on with your life, you made the same decision most Americans make. Target Date funds hold nearly $4 trillion in retirement assets. They are the default investment in most plans. The marketing pitch is seductive in its simplicity. Tell us when you plan to retire. We will automatically shift your portfolio from growth-oriented to conservative as you approach that year. Set it and forget it. Never look at it again. Here is what is not in the brochure. Target Date funds are funds of funds. They hold other mutual funds inside them. That means you pay the Target Date fund's own expense ratio on top of the expense ratios of every underlying fund it contains. At many providers, this layered structure adds 0.5 to 1% to your annual cost, compared to holding the underlying index funds directly for no additional benefit to you. Beyond the fee structure, there is the performance question. Independent research has consistently shown for 2 decades that the average actively managed mutual fund underperforms its benchmark index over any rolling 10-year period, once fees are accounted for. Not most years, not in difficult markets. Consistently, reliably, every year as documented in S&P's ASPIVA report, the most comprehensive ongoing study of active versus passive performance in existence. Over a 15-year horizon, more than 90% of actively managed large-cap funds underperform a simple S&P 500 index fund. You are paying a fee premium for a service that statistically produces inferior results. It is the financial industry's version of the premium appliance with the inferior internal components. The expense is real. The performance improvement does not exist. Everything described in this video is a machine running against you. Here is how you reduce its take. First, calculate what you are actually paying. Log into your 401k account. Find the investment options. Look at each fund's expense ratio. If that number is not visible on your plan's website, search the fund's name on Morningstar's free fund database or the SEC's Edgar system. Add the expense ratio to any disclosed 12b1 fee and any plan administration fee your employer has disclosed. That total annual cost as a percentage of your balance is the number you are fighting. If it exceeds 0.5%, you are losing money you do not have to lose. Second, find the index funds hiding in your plan menu. Almost every 401k plan today, even mediocre ones, includes some lower-cost passive investment options. Search your menu for funds containing the words Index, S&P 500, Total Market, or Russell. Compare their expense ratios to the actively managed alternatives. In most plans, the gap will be between 0.05 and 0.2% for index funds versus 0.75 to 1.5% for managed funds. Move your contributions to the index options. This single action, switching from the default managed fund to the lowest cost index fund in your plan, is the highest return financial decision most working Americans can make this year. It requires no financial expertise. It requires no market timing. It requires only locating the smaller number and choosing it. Third, sequence your contributions correctly. If your employer matches 401k contributions, take the full match before doing anything else. That match is an immediate 50 to 100% return on your contribution. No investment in the world competes with it. Contribute exactly enough to capture every dollar of that match. After the match threshold, the next dollar of your retirement savings should go into a Roth IRA, not back into the 401k. A Roth IRA gives you something your workplace plan cannot. Complete investment control. You choose the brokerage. You choose the funds. You are not limited to the menu your plan administrator constructed, which may have been influenced by revenue-sharing relationships you will never fully see. At Vanguard, Fidelity, or Schwab, you can open a Roth IRA today, hold nothing but index funds charging 0.03 to 0.05% annually, and pay zero plan administration fees. The 2024 annual contribution limit is $7,000. For most households, capturing the employer match and then maxing the Roth is the correct sequence, in that order. Fourth, if you want professional guidance, pay for it correctly. If your situation involves complexity, multiple old 401k accounts to consolidate. Social Security timing decisions, required minimum distributions in retirement. Professional advice can be genuinely worth the cost. But there is only one type of advisor worth that cost. A fee-only fiduciary advisor. Fee-only means they are paid directly by you, by the hour or a flat annual retainer. They collect no commissions. They receive no revenue-sharing payments. They have no financial incentive to put you in one product versus another. Fiduciary means they carry a legal obligation to act in your interest, not simply to recommend products that are suitable. The National Association of Personal Financial Advisors, NAPFA, maintains a public, searchable database of fee-only fiduciary advisors organized by location. That database is the right starting point for anyone who wants help from someone whose income does not depend on which funds you choose. Anyone who earns a commission from the products they recommend to you is not your advisor. They are a salesperson with access to your account statements. That distinction is not a technicality. It is the entire difference between someone who succeeds when you succeed and someone who is paid regardless of what happens to your money. Your grandfather did not have to know what an expense ratio was. He did not have to research revenue-sharing arrangements or demand a fiduciary standard or calculate the 30-year compounding effect of a 1.5% annual fee. He worked. The company kept its promise. The check arrived. That system was not perfect, but it placed the responsibility for retirement security where it belonged, on the institution with the resources to manage it. Not on a 35-year-old trying to make sense of a fund menu at open enrollment, squeezed between a dentist appointment and picking up the kids. What replaced it is a system that, by the federal government's own analysis, costs American retirement savers $17 billion a year in fees rooted in conflicts of interest. That money does not vanish. It transfers from retirement accounts funded by decades of honest work into quarterly earnings reports for financial services companies. The fee machine is not malfunctioning. It is performing exactly as it was designed to perform. But now you know what it is. You know the layers, the expense ratio, the 12B1, the administration fee, the revenue sharing that puts the wrong funds on your menu. You know what the math looks like when those layers compound against you for 3 decades. And you know the 3 moves that take your money out of the machine: find the index funds, open the Roth, and hire no one whose income depends on what you buy. The corporations running this system are counting on the complexity feeling overwhelming. They are counting on you staying in the default target date fund because the paperwork was dense and the numbers looked small and the decades felt long. The numbers are not small. The decades are not long enough to waste. If you found this useful, subscribe. Every video on this channel is an audit of a system designed to extract wealth from people who earned it. We cover the fee structures, the fine print, and the products they are hoping you never examine too closely. And tell me in the comments, what is your total 401k fee once you actually calculate it? Or how many years did you spend in a high-fee plan before anyone explained to you that the number existed? Because that number, and the silence that surrounds it, is the story. I will see you in the next audit.